Wait a minute, I thought stocks and bonds were supposed to be diversifying against each other. Yet I've seen stocks and bonds drop at the same time and the markets are down. Check out the historical data. Correlation isn't always your friend. Here's the Bloomberg data from 2008 through 2005 and Q3. The S&P was down over 36%. Look at 2008. Treasuries are up over 10%. And then gold was up over 5%. And then look at the 2022 inflation hit. S&P was down over 18%. Treasuries are down over 10%, and gold is only up a little bit over 1%. Or how about the 2013 bull stock market? The stock market climbed over 29% that year. Treasuries were down over 1%, and gold was down 28%. So over this period of time, the correlation of gold to the stock market was pretty low. It was about 0.16, whereas the correlation to bonds was about 0.4, meaning gold moved differently, potentially reducing overall portfolio swings. Correlation measures how closely assets move together. A 1.0 is very closely correlated. A -1 correlation is the opposite correlation. They move opposite from each other. Or 0, which is not correlated. Here, stocks and bonds had a slight negative correlation, but adding gold to that can really add some real diversification to the correlation. Though these correlations aren't guaranteed to never change, they change all the time. So this is historical data. The idea, well, gold often zigs when stocks and bonds zag. So it's a nice way to potentially smooth out your portfolio growth without giving up too much of your gain. But remember, all assets carry some sort of risk, whether it could be underperformance or volatility. How's correlation looking in your portfolio?